Thank you for joining me this Friday, the 31st of May. I'm Grady market analyst with Bell Direct, and this is the weekly market update. The energy sector has taken a few twists and turns in recent years, and uranium has certainly risen to the forefront of many countries and investor minds in 2024 amid increased demand for nuclear energy. Bell Potter's senior resources analyst, Regan Burrows, recently returned from a trip to Africa, where he visited some of the uranium sites, and he joined me earlier to discuss the outlook for uranium over the coming months, the fundamentals behind his rating of ASX-listed uranium miners, and just how mining in Africa differs from mining in Australia. Regan, thank you for your time today. You have recently returned from a trip to Africa for site visits to some of the mines you cover in your research portfolio. How was the trip? What did you visit, and what were the overall takeaways from your time there?
Yeah, thanks, Grady. So we went across to Namibia. Myself and the head of institutional desk, Jamie Gordon at Bell Potter, went to go see the Paladin site. As I was conducting a site trip, we decided to tack on a few extra days visiting the likes of Deep Yellow, which we cover, Bannerman and Elevate. Deep Yellow and Bannerman are obviously developers in the Namibian region, similar to Paladin, and Elevate's probably at the earliest stage in the exploration phase. Sort of in a nutshell, I think we were both quite surprised at the level of infrastructure and competency of the workforce within Namibia. Often as Australian investors, you sort of hear of Africa and you tend to shy away a little bit. But Namibia is quite an interesting place. It was populated by the Germans in the 1800s, and there's still a lot of German influence there. So we were sort of comfortable walking out and around at night. There's not any issues there. And Swakopmund, the main town where a lot of people live and transit from there to site out of Paladin, is quite a large town that still sort of has the vibe of a small sort of coastal retreat area, which was quite interesting. But yeah, going back to the infrastructure and everything, it was quite surprising and sort of similar to a lot of Australian sites we'd visited.
Now you have downgraded Paladin Energy to a hold post-trip. Why is this?
Yeah, so we walked away from the site trip at Paladin incredibly positive. I think everything's sort of running ahead there in terms of production to what they had initially thought. And the team there have done an incredible job, headed up by Paul Hemborough, the Chief Operating Officer. Everything looks great, but as is often the case, the valuation for these stocks tends to run sort of a little bit harder. And that's just the way that we've seen it. It's looking sort of fairly fully valued at this point. There's a couple of sort of catalysts on the sort of horizon that may cause a little bit of trouble, namely being Paladin will need to recut their mining costs with their contractor Trollop, which is a risk. Obviously, some of those costs may be offset by depreciation of the Namibian dollar and the South African rand to the US dollar. But it still sort of is a bit of a risk that we see. And secondary to that, and it sort of goes for a lot of the players in the Namibian region, is the upcoming election in Namibia in November.
Now, uranium continues to be the standout commodity of 2024 and isn't looking to pull back anytime soon. What are your key drivers for the uranium rally in 2024, and where is the price heading in 2025 or FY25?
Yeah, certainly. Uranium's done really well, and hats off to all the stalwart uranium investors that have been around for the last decade. It's been a long time coming. Look, the thesis remains the same, and that is that the market remains tight. The world wants to advance nuclear, and the only way you can do that is to increase the amount of fuel stock that you need for the nuclear reactors, and that's uranium, that's conversion, that's enrichment. I think we're going to continue to see tight markets over the near term, even with the restarts coming online, and that leaves the market sort of susceptible to supply side shocks, like we see when Cameco downgraded production last year, and the same when Kazatomprom did the same. The market, especially the spot market, tends to be a lot more sensitive to those issues. What I want to see is essentially us hold, or the uranium price hold, around this $93 per pound level, and the term price to catch up. And that gives the utilities, I guess, a chance to get used to the new world, which is higher cost for uranium going forward.
Boss Energy remains a key pick for Bell Potter and you as the analyst for this company. How is the company progressing at the end of FY24 and what is your outlook for Boss in FY25?
Yeah, Boss has been through a bit of turbulence of late. Obviously, there's a bit of noise sort of around the director sell down. It's never a great sign. I still think the company's quite attractively priced compared to peers, particularly given Alta Mesa is due to come online in the coming weeks. So that's their asset that's located in South Texas. I think that sort of sets Boss in an interesting light, given that it'll be a multi-asset producer spread across two Western jurisdictions. And in a world where geopolitical tensions tend to sort of be on the rise every single day, I think it's a quite sort of attractive position that Boss is sitting in. I think as well, the market sort of seems to discount the fact that there is expansion capacity at Honeymoon up to their export license of 3.3 million pounds. We sort of seem to miss that one when analysing Boss from a valuation point of view, and I think that makes it attractive.
Now, on the back of your trip to Africa, how does mining in Africa compare to mining in Australia for our investors who may not understand?
Investing outside your home jurisdiction is always a tough decision. It can be a rewarding one, but it is tough. And there are parts of Africa that are a lot more volatile. However, my impression of being in Namibia was positive. We had sort of concerns around water and power, given sort of Namibia is quite an arid, isolated sort of area on the western side of Africa. Those issues were alleviated when we went to the trip. So I walked away from sort of that being quite positive on Namibia. I can't say for the rest of Africa. There's definitely regions where it becomes a little bit trickier to invest around sort of government and whatnot. But as far as I'm concerned, in Namibia, it seems that things are a lot more stable and quite similar to Australia in many ways.
Does the government regulations and taxes, etc., play a higher impact in rating companies with assets in Africa compared to Australia?
It certainly does. And I think you've got to view every case separately. You can't just apply a blanket risk premium factor to a discount rate for operating in Africa, but it tends to be what most investors will do. And there's ways you can sort of go around looking at that and how to sort of factor that into your valuation. The biggest concern, obviously, is the equity-free carry interest that most African nations have or are looking to introduce. And I know that's been sort of topic of discussion in Namibia. The question is whether or not they'll actually bring it through and whether it will apply retrospectively to those companies that already have mining lease applications or mining leases. I think any change in government is sort of a little bit of a cause for concern, and that's what we sort of highlighted in the Paladin note. Compared to Australia, I think Australia also has its own sort of fleet of risks as well, whether it's individual government taxation, whether it's red tape around getting a mining sort of permitting and up and running, especially for uranium, for example, it's incredibly tricky.
Now, do you see laws in Australia changing around the use of uranium in the country and regulations around exportation anytime soon?
Look, I hope to see common sense rather than politics prevail in this aspect, in not only uranium and nuclear, but across the entire metals and mining sector. Government hasn't historically been the best allocator of capital. I think the equity market does particularly a better job at doing that. If it comes down to a decision on the cost of a project, why not open that up for debate rather than killing it in the crib because of some antiquated party ideology? That's my view.
Finally, where do you think we're at in the global commodity cycle? And are there any commodities rising up the ranks on your radar this year and why?
Yeah, good question. There's no doubt we've got strong tailwinds for a vast array of commodities, and during any sort of large cyclical up move, we're going to see smaller cycles sort of permeate over time, where supply and demand will overshoot or undershoot, causing a response in price. Outside of uranium, I still like graphite. It's a sector that's typically unloved, but could be a major beneficiary as OEMs seek diversification outside of the typical supply chain. Despite the younger generation, myself included, wanting to decarbonise and reduce environmental footprint, we still purchase devices that are heavily reliant on pollutive practices, such as the creation of synthetic graphite for batteries. And that requires taking the dregs, essentially, of the petroleum industry and heating it at greater than 2000 degrees in kilns powered by coal. And this is the product that allows you to sort of green shame your neighbor with your Tesla. So I think if we're being honest about creating a sustainable future, we need to revisit these practices, and naturally occurring graphite could be a beneficiary of this.
Thank you for your time today, Regan. We love getting insights from you and your outlook for key commodities in the current market landscape. Locally, from Monday to Thursday, the ASX 200 fell 1.3% as every sector closed lower aside from tech stocks, which was boosted by the tech-heavy Nasdaq on Wall Street, climbing to record highs throughout this week. The local inflation print for April ticked up to an annual rate of 3.6% from 3.5% in March and exceeded analysts' expectations of a moderation to 3.4%. Despite retail sales falling earlier in the week, providing support for inflationary contraction, the latest CPI print rising above expectations gives the RBA strong support to maintain the nation's cash rate higher for longer until the reading hits the target 2 to 3%. The winning stocks on the ASX 200 this week were led by Polynovo rising 5.77%, Illumina adding 4.3% and NIB Holdings rallying 4.25% this week. On the losing end, Boss Energy tumbled 14.71% over the 5 trading days, while Ordinate fell 12.3% and Fortescue dropped 7.43%. On the broader market index this week, the All Ords fell 1.29% this week as NextEd Group tumbled 18.75%, while Bowen Coking Coal declined just shy of 18%. The most traded stocks by Bell Direct clients this week were Rio Tinto and Sigma Healthcare. Clients also bought into Telstra Group, Adbury, Fortescue and Woodside Energy. Clients also took profits from Murray Cod Australia, WAM Leaders, Wesfarmers and BHP Group. And the most traded ETFs by Bell Direct clients this week were led by Vanguard Australian Shares Index ETF, Perth Mint Gold ETF and Beta Shares Australian High Interest Cash ETF. Taking a look at the week ahead on the economic data front, Australia's GDP growth rate data is out on Wednesday, with economists expecting a reading of 0.3% growth in Q1 from 0.2% growth in Q4, which will indicate modest economic growth in the current high interest rate environment. Australia's trade balance data for April is also out later in the week, where the trade surplus has been declining since November amid softer exports against imports. Overseas, US JOLTS job opening data for April is out on Wednesday, with the expectation of a slight decline to 8.4 million from 8.488 million in March. In Europe, the ECB will hand down its latest interest rate decision on Thursday night local time, where it is widely expected Europe's central bank will cut interest rates to 4.25% from the current rate of 4.5%. And that's all for this Friday. Have a wonderful weekend and, as always, happy investing.